Good girl.
All right, and we're live.
Yes, good morning.
A little late. It's been a slow morning. One of those days.
That's okay.
One of
Saturday
the-
morning.
Yeah, Saturday morning. We're not in a hurry. Are you in a hurry? Probably not. You might still be in your pajamas. So
Oh my gosh.
hopefully you've had a morning cup of Joe, or in our case, a cold coffee.
That's right. Cold brew.
So cheers. Happy
Homemade.
Saturday.
Of course, homemade.
Homemade.
Yes.
Oh, that's true. We didn't go
Yeah.
to the store to get it.
No, we have a coffee press,
Right.
and I brew it in the fridge.
Yeah. That's true. Okay, so you're right. All right. Hey, big topic today.
Yeah,
This-
it's big.
Yeah, we're going to talk. This is really going to be in-depth coffee and real estate. You're going to definitely need some caffeine to follow along because we're going to throw a lot at you. So, in the real estate world, obviously, we keep tabs on a lot of stuff that happens behind the scenes, just so kind of we can be in the know.
Right.
And whereas you guys probably don't have that information and or don't have time anyway. You might get blips of it in blurbs. There might be a newscast that says, oh, the housing's in a recession or the housing prices are going to crash and interest rates are going to keep going up. And all of a sudden, you just hear panic, fear, gloom,
Doom and gloom.
Yeah, exactly. So the question is all that true? You know, and then what is... Who is actually the little the Wizard of Oz behind the curtain, right?
Right.
So we're actually going to peek behind the curtain and show you the Wizard of Oz to let you know what is actually happening here in the U.S. and also in Oklahoma.
Correct.
Where houses are actually going, where they've
Yeah.
been, interest rates. We'll discover a little bit about talk a little about inflation.
Right.
We're not going to get in depth on the whole economic side of things. So
No.
That's out of this wheelhouse, but what we can do is take a snapshot of what the economy and real estate, how they're kind of tied together, and so where things are going.
That's right.
So you come to the right place if you want to know how, if you're in the process of wanting to buy a home, or you're thinking about it, you're sitting on the fence just because the interest rates are a little high and you're kind of shell shocked. Are they gonna get better? Should I wait?
Yeah.
So those are the questions we're going to answer. Is basically, you still want to rent?
That's right.
Is this a good time to rent still? Or is it time to even sell the home? What's out there?
Exactly.
So those are the kind of important questions that most people want to know. And we're going to kind of show you a little peek as to why the answer is the answer that we're going to give you. So stick around. So you're going to enjoy this
Yeah.
one.
Thanks for being here.
Yeah, appreciate it. All right. So, by the way, tell your friends and family about this broadcast. They can learn about the world of real
Yeah.
estate a little bit.
Be sure to like and share.
That's right. Always like and share, please. All right, here's a look outside. We always like to start the day with this.
Right. Nice and sunny.
It's nice and sunny. Already 85 degrees.
Oh.
It's going to be a warm one out there today. Woo, more
Goodness.
hundreds. More fun hundreds.
Right.
It is what it is, right?
That's right.
Okay, so here is, of course, the latest on the 30-year note
Right.
for mortgage. Still around 7.
Yeah. That's right.
I think the shock factor is probably worn off, 'cause
Yeah.
we've been here at 7, teetering back and forth from there, the upper 6s for a while.
That's right. When it goes back down to 6/8, it's like, whoa.
Yeah, I know. It's all like, woohoo. Now, here's the key, though, we're going to talk about. I'm going to show you that even matters. I'm going to show you if 7% versus 6 3/4 or versus 6.5 or even 6%, does that even matter when it
Right.
comes to dollars and cents?
That's
And
right.
you're going to be surprised at the answer. It's more of a mental shock value than it is an actual financial shock. And
Well, I think a lot of folks just fixate on the actual percentage number. But if the overall number makes sense in the end for their payment,
yeah, as we talked to Kyle last week, the bottom line is you always want to make sure when you're in a home situation that you can afford, you don't pay attention to all these other floating numbers. What you pay attention to is
the bottom line.
of your pocketbook and what your monthly payment can be.
correct.
Don't worry about for the house you
Comfortable.
want to. Yeah, for the house you want to be in, it's more of what your monthly payment can be, and that will dictate what kind of house that you can be into. I know it sounds simple and it's overly simplified, but sometimes people make it a little too complicated.
That's right. Yeah,
And
exactly.
these the quotes that you get from your lender take into effect some of those other things that you have that takes money out of that pool. So, for example, your bills, your water, electricity,
Car
all
payments.
car payments, all that kind of stuff is factored in with what you have to kind of give you a more accurate. So, in other words, we don't want you what they call house poor. House
Right.
poor is where, you're all in on the mortgage and you've got nothing left for lawn maintenance,
Right.
nothing left for food. Hey, but I got a great house. So the lenders are there as your
Right.
friend, as
Or
your
you-
guide.
Or you can't travel, or you can't get
Yeah.
your kids into certain
true.
sports. So there's limiting factors.
All right, so let's take a look
Okay.
at the market watch. This is the last 7 days here in Oklahoma County.
Oklahoma County. So new listings, 266 on market for the week. But what's interesting is the sold and the pending, 275 and 274. So those are huge numbers.
Yeah.
So there's a lot more being sold and have contracts written on them than there are new listings coming onto market. So
Right, and so that's kind of one of the things we're gonna get into is the supply side
Right.
of what's out there. So we had some clients that took them 6 months to find the
Ish.
house that they wanted because there wasn't a whole lot in their price range to pick from.
well, and when there was, you're
Yeah.
competing.
Yeah, and then
So-
when you was multiple offers and like, we lost another one. So it can be very frustrating. But anyway, so that's kind of the quick sneak peek of what's happening here locally just in the last week.
And people also shy away from doing multiple offers as well.
So here is an inflation calculator. So we're going to start to get into the nitty gritty. We did this
Okay.
just for fun last night.
Yeah.
So I wanted to see if you bought a $120,000 house in 2000, what would you have to pay for that same house in 2023?
Right.
So it went up almost 100%.
Right.
Yeah. So it would cost you $216,000
Right.
to buy the same home today that you bought in the year 2000.
Yeah.
That's staggering. So the
It
biggest
is.
take home you need to understand in this is not inflation necessarily, but an investment. In other words, you want to ride the inflation with your investment that rides inflation with you, right?
Right.
So remember, this is going to be built up because by this time you've probably either paid off your house or you've gotten close to it.
Yeah.
And all this is going to be an equity that from what you originally paid in at 120 to what it's now worth at 216, for example.
right.
So you get it back. So it's kind of a way to kind of save yourself from a big hedge of inflation that comes in. So
That's right.
that's like the biggest secret that nobody really talks about. So home ownership is huge.
That's right. It is.
Okay, so now let's get into what we want to talk about here. And
Yes.
we kind of did mention inflation. Historically, I got a lot of graphs here to show you. So
Yes.
this is the red line is where we are at.
Right now. Yeah.
And I'm going to start my little overlay again so we can see.
Okay.
But you see the big tall lines?
Yes.
What were those for?
So it's back in. Oh, I have to get closer.
You don't have your
I
glasses on?
No, I should have put my glasses on.
Oh, my goodness.
Oh, so look at the 1970s.
All right, so this is the
Yeah.
70s she's talking about
70s,
here.
yeah.
Off the chart. Inflation.
right.
There's the 80s.
80s.
90s,
90s,
2000s, two twins, and then where we are
Yeah.
now in the red. So it is,
Wow.
it's high, obviously, but it's
By the
not,
decade, yeah.
historically, it's not out of control high like it has been in the past.
Right.
But yeah, so that was an interesting note there. And we don't want to belabor too long on some of these because we do want
No.
to keep moving along.
Right.
So some of these we'll spend a little bit more extra time on and
Yeah.
others we won't. This is inflation. This graph just goes from 1972 to present. So I kind of cut 1872.
1872.
Yeah, so obviously it
Whoa.
goes through the wars where we had
Sure.
deflation.
Right.
But you can see in the last one, basically 1960 onward in this blue area,
Yeah,
that
I
is
see that.
all what they called stagflation and just
Mm-hmm.
inflation in general. And the last moving average that you see here, 10-year moving average is 2.65%.
Where we end up.
Yeah, about
Yeah.
3% on the inflation rate. Now, incidentally, home prices in Oklahoma go up on about 3% on average every year. So they're kind of moving along with the national inflation rate.
Right.
Okay, so now let's find out how healthy are you guys at home along with everyone else. And that's when it comes to the credit situation, both
Right.
your credit score and also how much debt you owe. All right, so we'll take a look at credit scores first. Now, this is an interesting chart.
Right.
So the blue, the light blue, is what?
760 plus
I
for
better-
credit score.
You need to get your glasses, man.
Yeah.
What's wrong with you?
Yeah.
Uh,
So that's like the top of the top credit score.
Yeah, so this is great.
Yeah.
Yeah, if you got credit in the 700s, you're doing good.
Yeah.
And if you'd look here, most people that borrowed
Right.
a mortgage, in other words, that that qualified for a home
Yeah.
mortgage were in this green or blue area, which
Yeah.
is over 720.
700.
The
Actually,
scale,
quite a few.
And the scale on the bottom on the left is 2003 to 2023. So we've
correct.
grown healthier as a country overall for getting really decent credit. And I think that's actually a
That's-
huge part of
That
things,
was,
right?
yeah, quite shocking to me.
Now, here's another.
Because we get those phone calls, and they're like, "Oh, we really want to buy a house. I'm not just sure about my credit."
Right.
And I always say, get in front of your lender. We always have lenders that we partner with, and they're the ones that are going to actually put in all the numbers and tell you for sure.
Now here's a little closer view. Not really. Actually, it's
Yeah.
especially the same graphic, but it does show
A little different.
that
Yeah.
most of the people that did qualify or get a
Right.
a mortgage were in the light blue area here of 760 plus credit score.
Very few with bad credit.
Yeah, and very.
It's-
I mean,
you
look
can
at the
hardly
bottom.
see that.
That's the dark blue.
Yeah.
That's on the map here.
Right.
Is this guy right here, less than 620,
620.
and that's down here in the noise.
Right,
So most
so-
people, when they are getting a home mortgage, their credit is at least greater than 600, and that's
Right.
not hard to get, by the way. So I mean, if you're worried about your credit score, believe it or not, it's probably a lot better than you thought it
Right.
was.
That's why I always say, get in front of your lender.
So how are we doing as far as delinquencies? In other words, debt that's not paid off.
Right. Exactly.
And if you notice, we had a big peak 2009, but when we got to 22, 21,
Yeah.
22, people became financially responsible over this
Exactly.
last decade and
Yeah.
paid off a lot of that debt.
Yeah.
So what are you noticing so far? You're noticing as a general trend for the entire U.S., we have better credit ratings. 2, we have less debt that we're not paying out on properly.
That's right.
Let's see. Let's take a look at some other interesting factors here. So this is also when it comes to credit cards.
Yes. I liked this one.
Yeah, this is a good chart.
Credit limit
So this is
and for HELOC.
and this is funny. So what you see is the credit card companies jacking up your available
Yes.
credit limit.
Of course.
Now that's a good thing because
It
you know
is.
what? It gets your credit score higher.
That's right.
Now they were probably hoping that everybody would start piling in with a higher balance, which is what
Yes.
this little darker blue is. Now if you notice, the credit card
People
balance
aren't.
is flat. It
Yeah.
barely has a little bit of an uptick in the last few years through the COVID period. So there's a lot more credit limit versus actual balances going on.
Right.
And then the red is just a line equity of credit that you have, line equity of credit.
That's right.
And it's been pretty steady.
Yes.
People just having credit that they take out of. But the good news is, again, we're not inundated in credit card debt
And it's, yeah,
as a country.
exactly.
And I was actually surprised by this.
I was too.
I actually thought everybody was living above their means and we're all in debt and everything else.
No.
Now, there is, because of COVID, there is a slight uptick in
Yes.
credit card debt and maybe buying a car during that period. So if you look at this chart here, as far as flows into delinquencies, auto and credit cards, in the last few months, we have had a little bit of a tick upward after this nice big dip during 2021
Right.
and 2022. So in the last few months, we have had an increase in that area. And some of that actually is also student debt,
Exactly.
believe it or not. Now, that's important when you look at this chart here. All right, so this is a breakdown of
Yes.
mortgages
Yes.
and refinances and where they do a cash out. All right, so that's kind of the big deal here. And
cash out meaning they're taking some equity out of their property.
correct. So why would you take equity out? Well, maybe you do want to pay off that student loan. Maybe you do want to pay off that credit card that did get a little high.
Or do a renovation.
Yeah, or home renovation has been popular.
Yeah.
Or the auto, maybe the car you bought.
Yeah.
So there's various reasons as to why you can take the cash out, and you can do it because everybody's sitting pretty good.
That's right.
Now, and that's is another graphic here we want to show you. That was
Yes.
this one. You really like this
Oh,
one.
I like this one.
So let me scroll this one down. The title here: U.S. homeowners.
Equity surges over 30 trillion as the value of housing stock passes 43 trillion. That's staggering.
Yeah, this is huge.
Yeah.
So you wonder why we're doing pretty good on our debt situation.
A lot of homeowners are sitting with a lot of equity within their home properties.
And that's free money, because, again, to battle against inflation. So
Right.
you earned it by buying a house.
So all those doomers and gloomers that think we're going to crash.
Right. So you've got a lot to go with here. And this is actually good because it saves you if there was a situation where
Yeah.
they were in a severe recession or a major crash, and at least you had some value there
Exactly.
to tap into should you find yourself in a rough spot. And that is where the Fed is trying to put everybody's in a rough spot because they want to try to curtail this inflation period, et cetera.
Right.
And they're wanting to do it by the old-fashioned equation of less jobs. In other words, more people losing out.
That's right.
And I hate that process and I hate that thought. But
So Joe Allison.
yeah. By the way, if you have any questions, feel free to chime in as we go
Yeah,
through this.
absolutely. So we have one here. We have a gold land real estate, great way to protect from inflation.
Always.
Absolutely.
Excellent. You are smart. You're on it.
Yeah.
Okay, so one more, and then we're going to get out of this one.
Yes.
So move on to our next topic. But do want to show you, though, foreclosures and bankruptcies.
Yes.
I heard that. Oh, don't worry. There's going to be a bunch of foreclosures in the market.
Oh.
Bankruptcies, et
They'll
cetera.
be waiting a long time for that to happen.
They've been waiting a long time. Look at this chart.
Yeah.
Like I said, we have become financially
Yes.
responsible since
Yeah.
2010. Those two factors have been in the noise.
Exactly.
That is not happening across the country. It's not happening in Oklahoma, not to any worthwhile degree.
No.
So that's, again, another good sign. So the reason I want to show you all these graphics is to show you
Yeah.
how healthy we are.
Yes.
And we want to say how healthy we are because this is what you get when you turn on the news.
Yes.
You ready? So here it is. Each year's different, but there
Yeah.
are some reasons they gave for home prices to crash over the past 11 years. 11 years, all you saw was us getting healthier and healthier and healthier. Shadow inventory, higher mortgage rates in 2013,
Yeah.
QE ending in October 2014.
Manufacturing recession.
Yep.
Home prices got back to the bubble high. 2017.
No good reason. They just wanted a housing crash.
2018, 5% mortgage rates
Mm-hmm.
started the bubble crash for sure.
Right?
19, home price growth was cooling off, and then of course COVID-19, mortgage forbearance,
Yep.
7% mortgage rates,
Yep.
and now 2023, historically low housing demand.
So that's it. Every
Well, that's what
single
that's
one
what-
of these,
yeah.
that makes the news.
That's
because
right.
it
Those are the
sounds
headlines.
scary, and everybody says, "Yep, we're heading for a crash."
Clickbait. It's all clickbait.
But this goes to show you, every single one of those has proven out to be false. But what about
Right.
recessions? Don't we have crashes during recessions? And that was actually a good question to answer.
Yes.
And this is what the data actually shows
Mm-hmm.
on some of the key significant recessions that we've had. They do not equal a housing crisis.
Right.
Home price change in the last 6 recessions from 1980 onward.
Yes.
There was a little bit of I would call it almost flat, but so 1991, and I
Yeah.
don't know all the details as to why that may have dipped a little bit.
Right.
But we all know 2008 was an oddity. It was an
Uh-huh.
outlier. There was a bunch of nonsense going on in 2008 that had nothing to do, that tied in from, it'll take hours to go into all that, but
Right.
you take away the ridiculousness that was allowed to happen
In
from
2008.
from various things we won't get into.
Various factors.
Yeah, that's the blip. But otherwise, if you take away the nonsense and the shenanigans, most of the time you're in the green. So
Mm-hmm. Right.
it does not automatically equate to that. So that's another falsehood you see sometimes from people that do talk. Now, this
That's
is where we
right.
mentioned the Fed. This is the United States continuing jobless claims.
Claims,
Now,
right.
if you notice the trend here, they are wanting to kind of go from, because there's September
Right.
2022. You have a nice, smooth, linear movement upwards.
Right.
And then it flattens out. It
Yeah. Mm-hmm.
actually dips down a little bit. So that's why the Fed keeps playing with interest rates and
Right.
quarter point here, quarter point there, because they keep wanting
want
this
that to-
curve to stop going down and go right back up again. So they want more people without a job. And
Mm-hmm. Right.
again, I hate that whole premise.
I
There's
know.
got to be a better way, but whatever. That's what they're going for. And so that's what's causing the uncertainty in the market and the interest rates.
Yes.
All right,
Absolutely.
so let's get to interest rates.
Yeah. I like some of these graphs.
Yeah, these are really good. So
Yes.
this is an interesting graph
Mm-hmm.
because this is where we are and have been since November of 2022.
Right. And this is the 30-year fixed.
Right. So what you see on this graph is a steep climb
Mm-hmm. Yeah.
out of those lovely low interest rates
Yeah.
in the 3s, et cetera, and 4s and 5s, and
That's
here we
right.
go up. And now we peak up and we max out around 7. This is the red line.
Yeah.
And we teeter back and forth. We're up, we're down, we're up,
Yeah,
we're down.
that's
But look
right.
at the consolidation. You see how the line gets tighter in this area?
Yeah.
So
Not a lot of movement.
Not a lot of movement. So we've consolidated around 7%. In other words, the market is stabilizing. It likes 7% based off of all the news, the fear and gloom,
Yes.
you know, all the other factors that come into this, forecasting, etc. So we've kind of peaked.
We have.
All right.
Right.
Now, let me see. I'm going to do, because these are all, oh, and also historically, just so you, just so you want to know.
This is also really good too.
This-
This dates back from 1975.
Right. All right.
Again, 30-year fixed rate mortgage average in the U.S.
So it peaked 1980s up around
Wow.
17.5%
18 yeah.
interest, which is ridiculous. And then we went
Yes.
down, 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 down.
Yeah.
And then bottomed out right here, which is right about 2.5%.
Right.
That's like
Ridiculously low.
That's like giving money away from the bank side
Yeah.
of things. The banks are like, "What are we doing? We're not going to make any money on this."
That's right.
And then now we've recovered back to around
Right.
7, which has been a pretty good historical baseline from the 90s to the 2000s.
But this shows you on, the trend of the mortgage rates. So
Yep.
I really liked this graph as well.
Okay, now the question is, where are we going with those rates,
Yeah,
right?
Right.
And then we're going to get into why are we not moving, right? Okay, so let's do a couple of forecasts here. So Goldman Sachs is one of the popular ones. There's a lot of forecasts out there as far as movement
Yeah.
is concerned. So they're, for their 30-year mortgage rate, what they expect it to hold around 7 for the next few months, and then teeter, they say,
Right.
to about 6.5%. Is where they think going to end 2023. All right, so that's a half percentage point.
It is.
Okay. And then this little dash line they have that goes out after that goes into 2024, 2025.
25.
They like the upper 5s. So they're not quite as bullish as some of the other ones. So they're
Right.
going about 6.25 to 6 throughout. Well, I would say this, about 6 to 5.9 sometime in the middle of 2024.
Right.
And then, but holding about 5.9.
Yeah.
Others are more like loosey goosey in the 5s. But the trend for these guys and others have been, once we get into 2024, it'll be a slow process, but we should get into the 5s.
Fives.
If only
Yeah.
by barely, but should get
I've
into
heard
the
that a
5s.
few times from some of the
And here's a way they can,
top people.
you can look at it rather than interest rates, but just like a price. They call it home prices.
Right.
The National Home Price Index.
This is Case-Shiller National Home Price Index
So
from January 2000 to April 2023.
So what you're seeing here is our steady line, our
Yeah.
slope, that's nice, consistent, linear of
Yeah.
home prices just gradually going up. And where they would have gone up minus
Yes.
COVID, this is the COVID nonsense over here on the left. So you
Yeah.
subtract the COVID nonsense and your slope would have continued to go in this direction. So that's all they're doing is they're matching the prior slope.
Yeah.
So it's not a very smart forecast. In other words, it doesn't take a lot of brains to put this together. It's a common sense that that's just what the housing market does. So let's go back to what it did. So they're calling this purple graphic here
Right.
is where they think it's going to go. So in other words,
By
from 2024 and 2025,
2026.
2026, yep, it's only a difference of like what 20,
Yeah.
20 points here from
Not
300
much.
to 322. So that's all they're doing. So basically, it means kind of flat is what they're saying because it needs a correction. The market needs a correction from
It does.
where it was going to kind of catch up with itself.
Right.
Okay.
And then hopefully once the rates come down, we'll start seeing more inventory.
Right. Okay. So here's another graph, another forecast.
Again, Goldman Sachs.
Yeah, this is what we call the bearish scenario. I almost didn't want to show this because there's a
Yeah.
lot of stuff on here, but you liked it.
It's a good one.
Yeah, so we'll focus here on
And
the,
again, we'll have all this in the replay.
yeah. So anytime you want to come back and watch this, tell your friends, hey, you got to check out this. They go all into the housing stuff.
Yes.
All right, so here's your existing inventory, year-over-year change.
Yes.
For 2023, which is this column here, negative, obviously, they got about 15%.
Yeah.
But they say 15% positive for next year.
2024. Yeah. In 2025, they're saying 13%
Yeah.
positive.
So there you go. So
Yeah.
they're thinking a correction to erase what happened this year,
Yes.
to get back to neutral for next year, and then to increase the following year.
Right.
That was one of their forecasts, and this is just inventory. This isn't price change. Just in other words, how many homes are there
Right.
you can purchase.
That's right.
Now, if you look at their bullish scenario, They were wrong. They were wrong. So their bullish note didn't pay out too well for 2023.
Right.
2024 they're going 20%, and then
20%, and then 5.
5 on 2020. It's almost like a huge auto correction.
Yeah.
Put too many homes on the market, and then back down more toward normal
Right.
rates. So that's kind of how their predictions are going.
Mm-hmm.
Let's see. And then if you look at, I think it was Morningstar, what they think.
Yeah. This one's a little bit easier to read.
So we're here. So this is where we kind of peaked out in the housing for
Yeah.
COVID, and then we dropped, and then now we're in this situation here coming into 2023, and then here's 2024.
So single family for the blue
2025.
and multifamily for in the red.
So they see a little slight uptick
Yeah.
through 2026, and then
Yeah.
we level off and maybe fall just a hair.
Yeah.
So kind of flat. I mean,
Yeah, kind of
not,
flat.
not really.
It's more of a lateral.
Yeah. Now this is where things get interesting.
Yes.
And this is the biggest takeaway you're going to have today.
Yes.
Why people aren't
Let's-
moving, why they're not selling their homes.
Exactly.
Because look at the interest rates they got.
Yeah. Why would you? I mean, there's only 26% that have 6% or higher. Everybody else is below 5.
So yeah, so you
So
have
that's like 90, 91, 90% of the people
Yeah.
have a mortgage
less than
rate
5%.
less than 5% and less.
That's a great interest rate.
It is.
If you were in the lucky ones that got into the 2s and 3s,
Yes.
oh my goodness, you were a quarter of the population of homes
Right.
that had a mortgage.
That's
oh my
right.
gosh. I mean, if you have that kind of a deal, why would you
Right.
trade that in for an interest rate at 7?
No, you wouldn't.
So that's the biggest hangover that everybody has, and it's a legitimate one.
It is.
And that's, again, why we have such low inventory.
Almost 45% of the people have an interest rate between 3 and 4%.
Yeah.
You think those people are going to sell?
No.
No.
No, not
They're
unless they have
not.
to.
They're still hanging on to their properties.
Okay, so that
Hence
kinda,
why we don't have many on the market.
so yeah, this is again we're explaining to you why there's less to choose from, and if it's a good idea to sell,
Right.
and if it's a good idea to buy. We're answering all your questions at once through the data. All right, now we talked about interest rates and inflation, etc. For home ownership.
Yeah.
What about renting? What has renting done
Right.
for us?
These were some interesting graphs.
Right. So I'll look at the historical trend
Yes.
first. Now this
This
is
goes back before 1963.
this is United States rent inflation.
Inflation.
So I'm going to have to move the graph up so you can see the bottom here.
Yeah.
All right.
So it started really, uptick. Back in what year is this?
Yeah, it's back
in the 80s,
No, in the 70s, right here.
70s, yeah. But then it jumped up to over 20%.
Yeah. So the
21%.
70s is a rough decade for
Yeah,
rental
yeah.
inflation.
Then it really came back down
Yeah.
in
So
the 80s.
peaked out at
And
20%.
then it sort of held steady right up.
Yep. Up until COVID.
Yeah.
And then it jumped right back up close to like 8%
Eight,
roughly.
8, 9, yeah. 8%.
So when people are complaining, hey, why is my rent going up? Why is my rent going up?
Well, now you can see it.
Now you can see how it did comparatively
Right.
speaking.
Because there wasn't a lot of rental increases between the 80s, 90s, and
Yeah.
the early 2000s.
It was, it's kind of like, how you want to know what your monthly payment is for your
Right.
mortgage? Well, in this case, you could know what your monthly payment was for rent. You didn't have to
Right.
worry about it going up.
Yeah,
That wasn't the case over the last couple of years.
that's right.
So take a look at the short-term version of that same graph from the 2000s.
Yeah, it remained really flat there for a number of years.
Huge dip because of the 2008 crash.
That's right.
Obviously, little knee-jerk reaction to that. Just like a knee-jerk reaction to COVID.
Right.
When you look up here at the top, again, this is National Single Family Rent Index, year-over-year price change. Went up to 14% peak briefly in 2022.
And now we're on a big decline again. So rental is actually looking at coming down.
Right, so now more toward this 2 to 6% range.
Right.
Here we currently
So-
are.
Yeah,
So what that should translate here in Oklahoma and surrounding areas is that
more affordable.
Yeah, the rent should be more affordable. They should shave $100 or $200 off maybe what you were paying.
They should.
Should wherever you're in. The national trend is that way, but now notice it's the national trend.
Yes.
Oklahoma bucks the national trend a lot. We're not as crazy on one way or the other. We're
Exactly.
more even keel, little bumps here in the road. You know, it's like a speed bump on a neighborhood.
Yeah.
You know, we're more of that versus a big cliff and a big mountain that some of these other metropolitan areas go through. So we may be a little bit more sheltered from this. But bottom line is rent
Should
it has been a higher, but it should
be
either
coming
flat
down.
or come down just a hair.
right.
Now, so does that mean it's a good time to rent? And we're going to get into that here in a second. So hold that question just for a few more minutes.
Okay.
All right, home price and movement. Let's get quickly into this. Just to show you the shift in, let's go, what do we do here first? There's so much to look at here.
Right. They're all good graphs.
I know. So that's the deal is they're all good. So, all right, we'll start with this one. This is the shift in the number of homes.
Going up for sale between June 2022 and June 2023. So over the last year.
And you see we're in the red.
Red.
In this
Red
area.
market saw a year-over-year decline in new listings.
So this category right here.
Yeah.
It's that big spot. It's the Oklahoma City metropolitan region. It's really all of central Oklahoma.
Yeah.
And this color red is right here about in the middle, which is about 24%.
Yeah.
So we saw about a quarter of less listings than we would normally see
right.
this time of year because of the way the market's been going.
Right. Well, and we saw in the previous graph the people with low interest rates.
Right. Okay, so this is going to be interesting. All right. Oh my gosh, it's kind of like sometimes I get data overload. So let's
Right.
get into the people, the demographics, who's buying,
Yeah.
the age group, all that kind of stuff.
That's right.
All
That would be
right.
that one. Yeah.
So we'll do this one first.
Okay.
So this is the age
Of the home buyers.
home buyers.
This one kind of surprised me a little bit.
I like how it breaks it down to millennials for younger and older.
Yes.
Then you have the Gen Xers. But if you notice,
And the younger boomers. So they categorized the boomers into two different categories.
yeah, older and younger, and the silent generation.
And the silent. Yeah.
'Cause they don't say much
Well,
until you get around them. Then they got no filter, and grandpa and grandma are just saying all kinds of stuff.
yeah. And they match the Gen Zers between 18 to 23 at 4%.
Yeah, so millennials are coming in strong.
They are.
For buying homes, and of course Gen Xers and the early boomers because they've got the equity built up from all the years, right?
Right, of course.
And for those that are rebuying
Right.
homes, not just sitting the one that they do have. So this is probably for all first-time home buyers.
Increasing
and-
their house in size or decreasing, just depending.
So that was, however, so that's the age group that are buying homes. But if you
Right.
look at this is interesting too, whether they're moving or not. And you notice that the movement of these different age groups has settled, meaning that people aren't moving around as much. If they're not
Right.
moving around as much, they're not selling their homes as often.
Right.
So even though they are in the active age group of buying, they're not exactly in the mobile version
Right.
of selling
Right.
to move somewhere else to buy
Exactly.
again.
They're kind of just holding.
And the most mobile area, which does make sense, is 25 to 34.
Yeah.
But
Those are a lot of the first-time home buyers.
yeah, but it trickles off pretty quick.
Mm-hmm.
Okay. Also, I thought this was interesting only because it ties into equity. All right. So buyers who financed their home purchase.
Right.
So the way I read this was those who didn't finance their home purchase, meaning they paid cash.
Yeah.
So if you notice, once you get into the 40s, 50s, 60s, and 70s, they had that equity built up. They had some savings. They took it all,
Yes.
sold their whatever home there was, and paid in cash. Whereas obviously the younger generations are having to finance
Right.
more of that debt.
That's right. Overall, 78% of all buyers did financing.
So this kind of ties into, are we in for a housing crash? All right, so this is a really important graph. So this goes back to 1990. All right, this is the purchase applications
It goes right up
index.
through till 2024. Yeah.
Yeah. So obviously had the big run up before the 2008
Yeah.
crash. That makes sense.
Of course.
While your chart's going down.
Yeah.
All right. And then we had this nice flat line period after that big change. Okay. And then we get back to where we were originally going.
Yeah.
That same slope has returned. You see it on the map from the left to the right. So this is your slope axis going in this direction. And if you get rid of this blip in history of a problem,
Yeah.
guess what your slope axis does?
Coming back up.
Resumes the same ratio it was before.
Trending upwards.
And of course, we have COVID, and then things get crazy, so it drops considerably. But then everybody's like, "Whoa, low interest rates," and then it goes right back up.
Yeah.
You know, and then now there's this yin yang, and then it's settling, and then oh no, market crash,
Little
recession,
bit of a yo-yo. Yeah.
job losses, fear, gloom, doom, and then boom, here we go with the correction in the market. However, look where it stops.
Yeah.
So we call this a test line or resistance, or actually support.
Support. This is support.
We call this a support line. So when you do day trading in anything, you look for support, resistance. This is a support line going all the way back to a decade. And we have tested that support numerous times and never went through it. And here at the end of last year, guess what? We're not crashing through it either. So this is a very strong indicator that this is it. What we're at is we've reached it. The housing, quote, recession is over. We had it. We were in the middle of it. We're at the tail end of it, according to this chart.
Right.
And if you were to look at this one here, which is a little bit of a easier read, because it's a shorter time scale.
Right, and this is pending home sales. Right.
So also kind of tails the same tail.
It does.
With a big dip right when COVID hits,
Yeah.
recovery, and then everything else following. And there's those last two blips here holding right at the line.
Exactly.
So stabilization is kind of like what we want to call it.
That's right.
And now when we look at the amount of homes that have been on the market,
Yes.
if you notice, not crazy unexpected,
Right.
look at several years where the peaks were in the amount of homes on the market, the 500,000, you know, in each of these little monthly time frames.
That's right.
2023, the black line here at the low end, peaking out around 400,000 versus say 600,000. So yes, low inventory throughout the year, as we talked about. Here, let's take count. Natives are getting restless.
All right. Got him.
All right.
My buddy.
Oh, don't make her jealous.
That's fine.
So we'll jump in here and go, where's my attention?
I just gotta put my.
Oh boy. I know what you're doing over there.
That's fine.
Okay, let's go into a little sneak peek, kind of what happened. Oklahoma got a little piece of this as well. This is a nice little chart. I'm going to have to blow up and zoom in. And we're going to get way up in here on this.
Yep.
And let's see here. So at the top are the months going left to right for the year. All right, December on the far right. And the year is on the far left. Okay, so we're just going to, what we're interested in is obviously this last couple of years.
Yes.
Okay, so what we have.
Okay. Let me put you down. There you go. Oh.
All right,
boy.
so 2022.
Yeah.
Obviously in the blue for housing prices increasing. And then here's what happened in the summer of last year. It all of a sudden goes flat during the peak of the summer sales season, okay? And then it starts quickly going negative. So in the last 6 months of the year, it was all negative. So housing prices went down in Oklahoma. So what you thought you could get, you know, at the beginning of the year was not what you could get for your home at the end of the year. And of course that goes to the winter months, which is typically lower.
Yeah.
And
That's
then
true.
look what happened this year.
Starts to go up.
We bounced back up. So we're back in the blue.
That's right.
Where housing prices are a little higher again than what they should be.
But not by much.
Yeah, only 1.5% at most. So that was interesting, but that is why if you've been out looking for homes, you're noticing the prices are a little high and or the multiple offers, because of the inventory.
Well, the multiple offers drives the home prices higher.
Now, how much of the correction does there need to be or has there been in this space? Let's be glad we don't live in a top 30 city because those top 30 metropolitan areas got slammed on home prices. All right, this is according to Zillow. New York was the first, or at least the number one on this list, just for various reasons. But the big thing you want to see here, the last column says change since March 2020. Home prices in New York went up 26%.
That's significant.
LA, 29%. It goes all the way down. Miami, Florida, 53%. Could you imagine?
Yeah.
Let's say you're looking at a $200,000 house. It is now $300,000.
Yeah, went up 50%.
Yeah, that's crazy. So anyway, this right here, these guys are going to have to correct hard.
Yeah.
So in other words, when you see the forecast for the nation to kind of flatline, maybe 1 or 2% growth over the next couple of years, because they have to correct for all this. This is a bunch of nonsense that occurred in the market. So these people, some of these may be upside down.
Yeah.
You know, not a whole lot of equity compared to what they own in debt.
That's right.
Now, when it came to buying homes, we had kind of a twofer here.
Yes.
And some people may not have qualified to buy a home.
Correct.
Even though those interest rates were great,
Yep.
things also change with lending and how much they feel comfortable lending out the money. And they'll use their own formulas.
Yes.
But what they decided to do was say that, hey,
So the median family income versus, and qualifying income.
they didn't qualify. Look at the top
Yeah.
numbers. Like, for example, we'll just put us in the South.
South.
So it's just obviously an average. But 89,000, let's say, was needed.
Right.
But their family income was only 83.
Yeah, so they couldn't qualify.
You don't qualify for a loan.
Yeah.
And that's frustrating, especially when you had those rates as low as they did. But that was back in the past, because I misspoke there. So this was specifically just to May. So I can't speak on how they were in the bottom of COVID area or the peak of COVID. But here with the interest rates at 7%, they've obviously tightened up the restrictions, requirements for the
Right.
loans. Because like, well, can these people pay
Yeah.
now that their monthly payment has gone up so much? You know, from
Exactly.
the 2.5 to 7% interest rate.
And that also limits a lot of home buyers as well.
So that we talked about kind of the seller end of limitations, but now that's the home buyer
It is.
limitation. All right, I think one more graph or two on this one, then we'll move on. All right.
Okay, so this is the shift in regional home prices since their respective pandemic peak. And this is according to Black Knight Home Price Index. So, Oklahoma,
We're blue.
we are blue. So, decline from peak through May
Is
2023.
right. So basically nothing.
Nothing.
So in other words, we're pretty flat.
We are.
You know, a couple percentage points.
Yeah.
But that's good.
Yeah,
that means
it
that
is.
we did not suffer that crazy yo-yo
No.
that I showed you in that prior graph. And you can
Right.
see who did. Down in Texas, the big cities, and,
Yeah.
and Florida a lot. West Coast, the mountains. I mean, that's a mess with
Exactly.
housing prices out there. Okay, now this is the good news.
Yes.
I guess it's good news. It depends on what you want to look at.
The other one was good news.
Yeah, that's true.
So this is where Zillow expects regional home prices to head between June 2023 and right up to June 24.
So you see the darker green, obviously it's higher.
Yes,
Why? They have a bigger deficit they got to make up.
they do.
You know?
Yeah,
But anyway, so I don't know what's happening out there.
I know. They're all moving here.
Right. It's going to drop. Whatever the first wave didn't drive people out, this second wave is going to drive them back to east to get cheaper place of
Right.
living.
That's right.
So for Oklahoma, we're in that little kind of a moderate
Yeah.
green, which is right around 3%.
3, 4, yeah.
And Zillow apparently has a little reputation for being a little too bullish, which means a little too aggressive on the percentage estimates. So what they think here is that we will resume our normal 3% increase in home prices for 2023. I mean, from
2024.
2024.
Yeah.
So keep that in mind. We get to the numbers we're going to do here in just a second to find out what that's going to cost you. For
Right.
example, you're sitting on the fence as you're a home buyer. You're
Yes.
like, look, it's 7% interest rate. I want to wait till it gets to 6. I'm going back to that first graph you guys showed me where it said 5.9 or 6. I want to wait for that time and then I'm
Yeah.
going to buy. It's been
Yeah.
basically a year from now. You know, I'm going to save all that money.
Right.
Are you though? How
Right.
much money are you going to save as home prices continue to increase here in the greater Oklahoma City area to the standard 3% climb?
Exactly.
What's your offset there? So that's a numbers game. We're going to show you what that looks like here in a
Yes.
second. And it'll
Hold
surprise
tight.
you. Yeah, it'll be
That's coming up right away.
eye-opening.
Yeah.
Okay, so we've covered the inflation and debt. We've
Yeah.
covered home price movement. We've covered rent, interest rates and forecasts. So
Let's bring up Oklahoma.
let's go to Oklahoma specifics.
Yes.
And this is some interesting stats here as well.
Yeah.
So I'm gonna do a historical
so.
graph here going back to 2018.
Yes.
Now this is just for June. We took a snapshot of June. So June is typically what, like the highest?
Typically.
Yeah. So
Yeah.
the highest traffic that you're gonna have.
And this is for new listings.
Now if you notice these peaks,
Yes.
huge peaks, and look what happened in 2023.
Yeah.
We had a big drop. Now remember that drop is estimated around 25%.
Yeah.
So there's an example. So sometimes we will follow the national average. You know, and other times we'll do our own thing. Some places are obviously a lot worse.
Yeah.
We didn't do too bad. A 25% drop though when it was available.
That's right. And this one is active listings.
Mm-hmm.
And this, again, goes back to 2018 right up to June of 2023.
So we had the roughly 1,300
Yeah.
active listings in
Yeah.
June historically, and this is before COVID.
Yeah.
The 19 was a little bit of a drop, but not too terrible.
Not much.
And then, of course, COVID changed everything, and we
Yeah.
have not recovered. We still got to get back to these early days of the 1,200 for us to be as
Right.
healthy in the movement of the market as we used to be.
That's right. Just
So-
over 600.
So we're still in that consolidation phase of the curve, just kind of doing this and settling down.
Yeah. And again, that goes back to people that are locked into that low interest rate.
Okay, so this is title of this one.
June 2023 month's supply of inventory. Again, this is for Oklahoma City.
All right, so you need to explain this one.
Okay, so this goes back again from June 2018 to 2023. Month's supply of inventory is only 1.5 months, just over 1.5 months of inventory.
And what does that mean?
Oh gosh. So that means that if everybody were to buy houses, we've only got 1.5 months of inventory. So it's not a lot.
So in other words, you're saying is if everybody bought today,
Yeah.
then the only thing left is a month and a half inventory. And usually you try to go 3 months. Is that what the rule is, hopefully? 3 months of
Yeah.
inventory that you can choose from that's there to pick.
That's right. So
Another indicator that there's not a whole lot out there.
no, there's not a lot of listings.
All right. And then if you're a seller,
So right now we know that it's a seller's market. This is market trends again for Oklahoma City, and this is based on single family residents. So again, we're looking at 1.57 months of inventory, and everything is selling 100% list to sale price. Average days, 6 days on market. I mean, I've seen even less.
we've seen a quarter of a day on a market.
Oh my gosh.
Goes up, comes down.
Comes
Like, well, that
down.
was fast.
Yeah.
So if you are still wanting to sell your home,
Yeah.
we are in a seller's market, which means you can get a little bit more value from your home.
Right.
It's still a little elevated. You'll have some multiple offers if it's priced right.
priced right.
And looks good.
And depending where it's located.
Right. Okay. So I think those are most of the graphs I want to show.
Yeah.
And then we've got, let me close this down because I want to show you the
Oh, yes.
homes for sale. One last graphic here for
Yes.
Oklahoma City. This is the MLS. So this is Oklahoma County.
Yes.
So I just want to show you a bigger picture. We're doing Oklahoma City there for a minute, kind
Yeah.
of focus. This is Oklahoma County, which covers all the metro.
Yeah.
Just to show you that in 2018, again, we're up around 2,500 homes.
Yeah.
And we're up around 1,500 this time around. So
Yeah, it's-
about 1,000 less
Yeah.
in the Oklahoma County
That's
area.
huge.
That's a big drop.
Yeah.
So that's why you have a lot of realtors that are like, know of anybody trying to buy or sell a house? Because I don't know of anybody, you know.
Right.
So where is everybody?
We're asking.
We're asking.
We're always looking for homes for our buyers.
Yep. So, okay. Now, I think it's the time we get into the numbers.
Yes.
Let's figure out reality. Let's separate fact from fiction.
Yes.
So let's go back to what I talked about before. If you wanted to wait, are you on the fence? Is it now a good time to buy or is it a good time to rent?
Right.
Kind of a deal, right?
So
So we're going to do a standard 30-year FHA mortgage. So in other words, first-time home buyer, for example. We can pick other loans. They'll all be kind of similar. We'll just start with this one. It's easy.
yeah.
Okay. And we're going to start you out 7% interest rate,
Yeah.
$250,000 home.
Yeah.
That seems to be kind of a median price range here in Oklahoma. We just looked at the data for that for our area. We threw in just homeowners insurance and property taxes and your HOA fees. So we kind of just threw in
Right.
a few numbers there to kind of give you a more accurate representation of what you'd be paying if you were out to get a loan today.
Yeah.
All right. So you got the number here on the screen.
Yep. 2157.
All right. So keep that number in mind at home.
Yes.
All right.
Remember that number.
2157.
2157.
Now, let's do some math. This will be fun.
Yeah.
All right. So let's say we do climb at our standard 3% increase times 250,000. So
Right.
what is this home a year from now? This 250,000 home going to sell for? It is now going to sell for $7,500 more.
Right.
Okay. Now remember, your idea is to save money. So let's see if you saved any money.
Right.
All right. So now
Now we're going to add 7,500.
257
500.
5. And we went from our 7% rate to a 6% rate.
Right.
What did we end up with? 2058.
2058.
What did you save in that difference? 2157, 2058.
Roughly.
You
100.
saved, just under $100. You
Just
saved
under.
$99.
Yeah.
So in that particular case, you're thinking, hey, I came out ahead, right? I saved $100. And I waited a year, and I still got the house I wanted. You know, assuming it was actually available the whole
Right.
time.
That's right.
And this is this approach.
It's all hypothetical.
Right. Now, the question to you is, and it might be, if you're in that price range of $250,000, is $100 a month a deal breaker for you? In other words, in your mind, is paying that extra $1,200 for the whole year, is that worth sitting on? All right. So that's what your first thought process is as you get your brain going. Now, here's where things get fun.
Yes.
Okay. Let's
Still
take a
with
look.
us?
Yeah, that's the basic easy part.
Yeah.
Now we're taking a look at you decided, you know what? I'm going to go ahead and buy the home. All right. How much at a 7% interest rate when you're paying $250,000, in your monthly payments, et cetera, and this is just going to be a ballpark figure.
Right.
You're going to be paying roughly about $210, maybe a little higher on average per month in principal. This is where your equity builds in.
Yes.
All right. So let's go over here.
Yeah.
$210 times
12. $2,520 in equity.
So here's the deal. You waited, right, till the following year
To purchase at the
that.
lower interest rate.
And it saved you a total of $1,200.
Right.
Right? Here, you bought it, didn't wait, you paid that 7% interest rate, and you have $2,500 in equity, which is more.
Right.
Yeah.
The equity.
Your equity. You
And
save.
your homeowner.
You save more money in the equity than $2,500. Plus, like you said,
Yes.
you're a homeowner. Secondly, we forgot this cost us $250,000. The other one cost us $257,500. So now you're already negative because now you've paid out another
paid more.
$7,500
By
you didn't want to
waiting
pay. By
another
waiting.
year.
So in this example, it didn't do you any good to wait.
It costs you money.
It did.
Yeah, it costs you money to wait.
It costs you.
So if you're sitting on the fence,
Yeah.
thinking I'm going to wait till the rates come down, there's calculators out there. We just proved to you it's not worth the wait.
Right. All right. So that's one aspect. If
Correct.
you're trying to get the interest rates down a whole percentage
Yes.
point, because you're thinking, wow, 1% should move the dial pretty good, right?
Yeah.
For those that are going, I want to wait for 0.25%. Does a 0.25% matter? All right. So we're at 7 today. So we're back up to 2157.
Right.
So now let's go to 6.75.
Right.
What does that say? 21.17.
17.
So $40.
Right.
All right.
And to some, that's a lot.
So a quarter of a point
That's
is $40. Now, if you're in this price point though of a $250,000 home, odds are, if you really think about it, $40 a month is probably not that much to you. You're going to spend that on your coffees and on your this and your that, your luxury items anyway.
Right.
A month, and your Netflix and chill and whatever else you have going on. So you don't think of $40 a month being too bad. you know?
Right.
So if you're in that price range. So there's an example of where a quarter of a percentage point, which is significant in the market movement,
It
right?
is.
Because everybody's freaking out. Oh, we went up 1/10 of a point. Oh, it's
It is.
and they're talking about a quarter of a point, quarter of a point. In reality, in the numbers side of things, it's not that big of a change. So I want you to get past the mental hang up
of the
of
interest rate.
rates, because when you actually do the numbers associated with it, it's not as significant as you think it is. And don't let that be what holds you back from achieving your dream home, right?
That's right.
Or getting out of a situation you're currently in, which is rent. And that's the one thing we did not add
Yes.
to the prior calculations. You just spent that entire year
Renting.
saving money, spending all that money on rent.
Yes.
to give it to somebody else.
paying your landlord's mortgage.
Yeah, and you're paying his mortgage, and you're building up his equity instead of yours. That's
Yours.
a double loss.
It is.
So, and honestly, unless you have a situation where renting is really required because of some stringent, either family situation or financial from work or something, unless you're in some odd place in life renting is typically not the answer.
It isn't.
Home ownership is.
Right.
And most people, we talked about this just the other day,
Mm-hmm.
between 3 and 7 years will own a home before they move. And you can build
Yes.
up quite a bit of equity in that
can.
time frame.
Yeah, absolutely.
That you can take with you
Yeah.
to the next home or to do something else with that money. Okay, so I thought that was kind of important. I wanted to get into the numbers. Let's kind of recap what we've got here, because I know we're going almost an hour now.
Oh boy. Well, there's a lot of information to cover.
There's so much. By the way, we got some more. Oh, good. So let's. And if you had any questions, by the way, just chime them in the comments section.
That's right. So
let's just go over some quick facts that we
recap.
kind of a recap of the summary.
The economic sector is looking at homes like stocks and not quite a dwelling.
Right. So in other words, when you hear all this talk, they're treating everything like it's a stock. Like, no, people live here. They have no intention of flipping this. We don't live in this house for 6 months, flip it, go buy another one, live it for 6 months. It's not a movable item. It's something we live in. You start your family in. It's a place called home. It's where you get settled.
Right.
So you have to ignore the economic chatter when they're trying to relate it to a movable stock that goes up and down based off of some rumor of the day.
Well, and that's why you should be talking to a professional. Currently, the market is stabilizing. Interest rates flatlining at 7%.
Yep, and we showed you the long-term graph of that. It's a very good support line.
It is.
Meaning we shouldn't really climb much, and the health of the housing market shouldn't change any from where it is currently.
Most outfits forecast a slow increase in home prices by 1 to 3% over the next 3 years to allow for the correction.
Right. So this
again, we showed you.
Yeah, this is on an average. So
Yeah.
again, like a 1% the first year, so 2023,
Yes.
then a 2% climb for 2020, or excuse me, 2024, 2%
2020.
time for 2025, and
Yeah.
3% for 2026. If I got that right in my math.
I think so,
In my
yeah.
head. 24,
There's a lot
25,
of graphs,
26.
so.
I know, I got a lot of numbers going on. But now remember, that's a national average.
It is.
And that is a correction for, we showed you the top 30 cities where they overspent 50%. So they have to correct somehow. And there's actually some forecasts that are negative, like a negative 1%
That's right.
growth in prices. Oklahoma, because we're kind of sheltered, protected, both from incoming transfers.
Yes.
Oh, that map. Oh, let me show you that map real quick. Oh,
Yeah.
That's the one thing we didn't show.
Yeah, we have a lot of.
And you
yes,
found this. I thought,
found
that
this.
was an awesome map.
Yeah, I thought this was really interesting.
Now, this ties into what I just said. All right, where are people moving from
Right.
here? When they say, oh, they're moving here, where are they coming from?
That's right.
So this is kind of a breakdown.
Moving to Oklahoma.
Moving to Oklahoma City. All right, and believe it or not, look at where these destinations are. A lot of West Coast,
Yes.
as we talked about before. Colorado, Chicago, Dayton, Ohio.
No.
Is that
Those ones are moving from.
in Washington? No,
These ones are going. These ones are coming in.
No, look. No, this is moving from. We are moving to.
Oh, yeah, okay.
Yeah, so I'm on the moving from.
Okay.
Moving to is in blue.
Right.
Where Oklahoma's going, they're escaping. They want water.
Yeah, they want
They're
water.
so tired of being landlocked, they're going to Florida or the Gulf Coast
That's right.
or Hawaii. Now, why all of a sudden they're going out here to Greensboro? I have no idea what's out
Right.
there for Oklahoma, but some of you are going out there. But anyway, so back to Oklahoma, moving in,
So the number one,
L.A.
yeah, California
Yep.
and Texas.
Look at that, Dallas.
Yeah.
What are you people in Dallas doing
Yeah.
here?
San Francisco,
Yep.
Seattle, Denver,
Yep.
San Diego, Dayton, Ohio, Washington, D.C.,
Mm-hmm.
Chicago, and Weatherford, Oklahoma.
That's right. What Weatherford? What are you guys doing out there? But so those are the top
Right.
movements. Now that's not a snapshot for the last 3 years.
Right.
That was only a snapshot from April to June. And
Right.
it was just this big moving period of cycle. And these numbers could have varied any time. Yeah, because we have a lot of Californians, so it kind of depends
Yeah,
on
we
what's
do.
moving,
That's
jobs, that kind of deal. But the point of that is with that incoming movement in, it's helping to keep
Yes.
us more stable.
It is.
And allowing us to be closer to our normal 3% rise in home prices.
That's right. Well, and that brought me to, So Oklahoma City saw a 24% drop in the number of homes going up for sale from June to June, so year over year.
Yep.
Zillow forecasts Oklahoma City to remain near a 3% increase in home prices. Predictions indicate possible 5.9% interest rates by summer of 2024. Job loss recession will create more sellers in the market. Otherwise, expect lower than normal inventory going into 2024.
So that's the
Yeah.
frustrating part on this. This is not
Right.
going to be an immediate fix.
No.
But although we're not in a crash and the recession is over, we're
Yeah.
in the stagnant part of leveling
Yes.
off and a slow creep up. So that means inventory was low from
Yeah.
this summer onward. It will continue to be into next summer, which will keep the housing prices slightly inflated, outside of the normal rise because of the multiple offers.
That's right.
So in other words, status quo. What you see today, you will see tomorrow. Tomorrow being a year from now.
Yeah, exactly. Top 30 largest metropolitan areas saw a 25 to 50% increase in home prices since the 2020 pandemic.
And that actually could be a
Yeah.
reason maybe why some people in Dallas are moving. They're like, maybe they were apartment renters and they're like, I can't
Could be.
afford a home here.
Right.
But you know what? I can go up the road to Oklahoma City,
It's not far.
get one for half the price. It's a
Yeah.
3-hour drive. No problem. Done.
Yeah.
And that could have been a factor.
Yeah, that could have been. 42% of homeowners don't have a mortgage. They paid it off.
Man, you need to say with an explanation point,
Right.
don't have a mortgage.
42% of homeowners don't have a
I
mortgage.
had no idea that many people own their home
That's
outright
right.
in the
Yeah.
country. 42%.
Yeah, that's huge.
So they're off the table.
Yeah.
We're not even talking about those people. Those
No.
people are fat and happy. They're
Yeah.
good. They're not going anywhere.
No, that's right.
And they don't even care about interest rates. They're like, why do you guys all worry about interest rates? I got zero payments.
That's right.
But that number was staggering because I really
Yeah.
thought that most
huge.
people still owed something on some type of loan for their home.
Right. Okay, so 90% of outstanding mortgages are below the 5%. Experts predict more market movement once interest rates drop into the fives.
Yep, and that is
Well,
because
it's understandable.
Yeah, that's the mental thing, right?
Yes.
Because if you're already at a 5 or a 4, it's easier for you to make that jump. To go, oh, okay, just a few points up for a 5. That's not a big deal.
Exactly.
For what? And again, we did the numbers.
Mm-hmm.
It's mostly mental. Unless you're just hurting that bad, where a few bucks a month, will stretch you. And if that's the case, you might want to look at your finances in general to see where you can cut and trim. What's more important to you?
Right.
Is it the subscription model to this, or is it in a home that I've always wanted? Right.
Exactly.
Okay, so if you were to summarize those key points like all together,
That's right.
the result is we have a modestly healthy credit profile across
Yeah.
the country for everybody. And I was blown away by this data.
Yeah, the debt to income
and
ratios.
With the debt to income ratios. What's that beeping? All right, we got some beeping going on. Anyway, I don't know what that. Fire alarm? Nope. Okay, we're good.
I think it's our water softener.
Oh, it could have been. Okay, so anyways, where were we? Okay, so that moderate, healthy credit profiles with debt to income ratios. In addition, 90% of homeowners have an interest rate that is below 5%.
Yes.
Okay, and then some, in this case, in those bigger markets where they kind of overpaid for a home, they have little equity built up, especially if they just bought during the pandemic.
At the inflated prices.
Through the overpriced purchases. So the point is, you wrap all those in together.
Yeah.
The desire to sell a home is in the toilet. It's low.
Yeah,
There's
of
no,
course.
because of those confounding factors. There's no significant strong motivation
Absolutely.
to move. And I get it. Most people are in that situation. I see no fault in that. I'm with you. That's all
there's-
logical to me.
Unless there's a life change.
Well, and
life-changing event.
that brings up the second point.
Yeah. So most people in a position to sell, again, would be because of a life-changing event, such as a family dynamic, job loss, relocation.
Yeah.
So others would be in a luxury home bracket that is shielded from market factors mentioned above.
Yeah, so honestly, we're talking, a lot of us folks that are,
Yeah.
because the 250 to 350 price range is very popular. It's a lot of middle class America. So we're kind of focused on that group.
Yes.
There's obviously a lower income group and there's an upper income group.
Right.
It's the lower income group that typically rents a lot more. Because there's not a whole lot of homes, right, in that price range that aren't rentals. Because that's been the industry flip model of renting.
Yes.
So they snag them up, these industry investors, because they want to rent it out. 'Cause it's cheap for them. They can make their profit back. But on the upper side of things, for the luxury homes, they're not concerned about a 7% or 6%. So they'll be the ones moving as well. So so that market is kind of unfazed by a lot of these economic conditions.
Correct. So if there's anything that you need to take away from all of this, is that renting is zero equity regardless if the rent prices flatten.
Right. And we talked about that. We showed you the graphs, how they've done a big correction since the peak of COVID. They kind of flattened out. They might go down a little, but kind of in that zone. But it doesn't matter. It's still zero equity. You're making no money.
That's
You're
right.
giving money away. You're paying someone else's mortgage. You're not making anything for yourself.
No.
It's
No equity.
It's like if I walked up to you and I said, "Hey, here's $200 a month for you," and you said, "Yeah, just put that in the trash for me, would you?" That's what you're doing. I'm just telling you. That's as silly as it sounds. Or I got a toilet over there. Can you flush it for me? I mean, are you serious?
Right.
So, yeah. All right.
That's right.
And then here's kind of a recap on the financial side of things. We're looking
That's
at the
right.
interest rates.
Yeah.
So waiting a year to buy in hopes. Remember, this is just in hopes. These are all forecasts. It could be wrong. We could hold that 7 to maybe upper 6s for a much longer period of time. There are some that do forecast us not to get in the 5s at all next year, and it kind of teeter up around 7. But the point is, while you're sitting on the fence and waiting,
Right.
hoping that rates drop a percentage, you're missing out.
Right.
Because you're still going to have a typical 3% increase in home prices. So that's on our example of a $250,000
Right.
home. That's an extra $7,500 that you're going to have to pay whenever you do decide to buy a year from now.
That's right.
And then you're going to negate the money that you would have saved by paying the principal. All right. So there's easily about $1,200 that you missed out on that you could have had built up in equity.
That's right.
And then the $2,500,
Which was the equity.
Oh, that's $25 was the equity.
Yeah.
Oh, the principal was, I don't know what I was writing
That's
here.
okay.
That's okay. I got a little excited, I
That's
think.
okay.
It's okay. Hey, I did these numbers at like 11:30 at night.
Right.
So I'm like, where am I? So the bottom line is, between the fact you missed out on the equity that you put in and the
Right.
fact you have to pay an extra $7,500, it was like, it equated to like $8,900 in our example. So about
Yes.
$9,000 is what you missed out on by sitting on the fence for a year. Now, what would you do with $9,000? Well, you go on vacations, 2 of them, 2 really nice ones. Maybe go on 3 or 4 cheaper ones.
That's right.
Buy a new computer, maybe buy a used car, whatever. But that's the kind of value that you're missing out on by hoping and waiting
Right. Yeah.
between now and a year from now, and hoping that you get an interest rate from 7 to 6%, buying the same price of a home that
Exactly.
you're trying to go for. And then the last thing we want to bring in is key point.
Is only buy the house that tied into what you can afford to pay a month.
Yeah, your monthly payment.
Yeah.
It's all about your monthly payment and what you
That's
can
right.
afford. You might have this idea: I want a home that's $300,000. I want a home that's $150,000. Doesn't matter what you want; it's what you can afford. And again, that's where
Comfortably.
that's where the lender comes in. The lender will tell you, look, it says, I'm not going to put you in anything that's going to put you upside down. That's why I need your pay stubs. That's why I need your W-2s. I need what your current debt ratio is. How many things you have out right now that you owe on.
That's right.
Car loans, whatever, student loan. They're going to factor all it in to let you know exactly the peak, the max of whatever home price you can look at. When that happens, the lender and yourself, we then come into the picture.
Yeah, that's right.
We all have the conversation. We say, okay, we got you. Then we put you on the Home Buyers Advantage program. We get you on the search. We'll find exactly the home that fits your price range, because we don't want you put in this tough situation where, well, I got a great home, but I can't afford lawn care. I can't afford electricity. I can't afford water. It doesn't do anybody any good, right? You're on your side.
not.
So we're going to make sure that we're all playing fair here.
Yes.
So that's the issue with that.
That's right. All right. So if there's anyone close to you that would benefit from speaking with us, reach out.
Yeah, this is just an example. So
Yes.
today we spent an hour. So if you say, do you guys really do your research? Are you in it for a quick buck? Where are you coming from? Are you
Right.
serious? The amount of time it takes just to learn this space, to learn all the intricacies, because we want to know. We want to know everything. And why do we want to know everything? Because it helps you. It helps us educate you. It helps guide you better. It helps us to help you make better decisions.
We want to be the expert in our
Oh,
industry.
for sure. I first off, I drink out of a fire hose.
Right.
When it comes to anything new in life, I want to learn it all, and I learned it all yesterday. So I sit there and just consume it like a crazy wild man, and I
Right.
want to know all the moving parts so it all makes sense in my mind.
Sure.
So that when I go to educate someone, I know as much as I can possibly know, so I don't lead you astray. And I hate con artists. I hate, seriously, there's so many of them out there. It irritates me. I don't like people who put in a 2% effort at A&M. We
Right.
called it 2%ers.
Okay.
Yeah.
Really?
Yeah, it was an Aggie thing. It was a knock
Yeah.
on anyone that we didn't like that didn't put in the effort. We call them a 2%er.
Okay.
Yeah, which means
I like that.
Yeah, it means you're the laziest, lowest form of any work ethic or whatever.
Right.
2%er.
Just getting by.
Just get out of here, 2%er. You know, it was a dismissive term. It was in fun and jest, but it's still,
Yeah.
you know, we say it in joking 90%
Sure.
of the time or whatever, but that's the idea. And I want to be 110%er, right?
Right.
So I want to be the complete opposite of that.
course.
I want to make sure that I am well versed in anything because I don't want to feel naked going into any conversation.
Right. And that's why we take information from various sources and make sure we just don't go to one source
Right.
and think that's legit. That's all there is. Because there's, as you saw by all our graphs, there's multiple platforms that provide content and information
Yeah. Oh, yeah.
regarding how the market is,
Right.
what's trending, what's, you know, with the inflation and job market. Yeah. So, yeah.
So, yeah, just to summarize, let you guys know here at Team
Yeah.
Tuttle Realty, we take this very seriously. We want to make sure that we can save you every dollar that we can do it, give you the best value, the best best house, the best bang for your buck.
And that you're educated along the way,
Yep.
and that you understand the process and each step.
And then we're part of a huge team, so there's not anything that we can come across
Right.
that you guys had. You're like, well, you can't help me. No, I bet we can, because if we don't
Yes.
have the answer, we have a large team
Someone-
that's just about seen it all.
Yes.
And I do mean the largest in Oklahoma. So we can
Yeah.
always refer back to our partners in that world, in that space.
That's
Go,
right.
hey, I got a wild one for you. You know, how did you handle this? Or, you
Yeah.
know, what should we do?
Yeah.
So there's always going to be a lifeline or assistance.
That's right.
That we can't figure out or don't know on our own.
True.
Just from all the work that we do personally. And again, you've been doing this for 13 years.
Yeah, 13
So let's take your
years.
first rodeo.
This is not my first rodeo.
I've been doing it for a full year, so I'm over the
Yeah.
past hump of the new agent, you know.
That's right.
And it has been an eye-opening experience. I've learned a lot in
You're
real estate.
And we still, I'm always learning.
Oh, and we do. We talk to people all the time.
Continually learning.
They say you never stop learning
No,
in this
you
space. You don't. It's something will always surprise you. Something new will come up. So that it keeps it interesting. And that's the other thing, is it does keep it very, very interesting.
There's a lot of information out there, so.
And finally, you know, we're not the type that are chasing dollars, and you will quickly
Right.
find out from a realtor that you've worked with, or realtors that you know, if they're dollar chasers or
Right.
if they're actually just want to help you. Just kind of give you a example of that. If they're pushing you to make a decision and they're kind of hardcore pressing you, they're chasing dollars and they're irritated because they don't want to spend any more time on you. They want you to make this so they can move on to the next mark. Now, you notice how I called you a mark. You do not want to be a mark. Right? That's the negative side of real estate. And there are some out there like that. However, for us,
Yeah.
not at all. As a matter of fact, we talked to a lender yesterday, and he's like, you know, tell us, you know, he was like, let me learn a little bit more about you guys and your approach. And I told him, I said, I'm not in it for the money. I just want to help people.
Right.
Because that's what I already do. You know, so a lot of times when you help people, the money will come. And it's,
That's right.
yeah, and the money should not be your goal and your focus
It should
in
not
life.
be your driving factor.
No. Your health should be, your family time, you're giving back to the community or helping your fellow man. That
That's
has a
right.
better, bigger reward. You know, using your gifts and talents to help others, far more better than a few extra bucks.
Well, and that's one of the biggest reasons why I got into real estate,
Yeah.
was because I thought there was something lacking in the system. So,
And unfortunately, it's people sometimes.
well, in my case, it was.
Yeah.
So I thought, what can I do better? How can I change what's happening?
Right.
So
That's good.
I'm just one person.
Yeah.
Now we're two people.
One person
So,
making a difference. But
right.
what's neat is that in this space you will find other like-minded individuals, and then you'll team up,
Right.
right?
Absolutely.
Because you have the common vision, the common goal, the common thought process. You know, for a means from A to B to get there.
Right.
And you gravitate toward those people. You want to surround yourself with like-minded and successful people like
Right.
you, that are ethical, moral. That they're not in it for this, that, and the other. They just want to do a very good job and help others.
That's right.
And that's it. I mean, if you can gravitate toward those people in life in general,
Yeah.
you're much better off.
Oh, absolutely. So do your due diligence.
All right. Well, hey,
Call us.
this is one of our longest
Oh
Team
my
Tuttle
gosh,
Realty
yes.
live broadcast ever.
But there was a lot of information, and it was overdue.
Yeah. Oh my goodness. Yeah, because we talked about it, said, okay, we don't have an interview today. What do you want to talk about? We're like, oh, what do we not want to talk about? Because there's so much that we
Right.
follow. And I said, you know what, let's put it all together in one. Let's just get it over with. Let's just throw it out there so that everybody can know what's behind the scenes.
Yes.
We talked about the Wizard of Oz beginning of the broadcast.
Yeah.
We'll show you who he is and why things are going the way they are and where they're headed.
Yeah.
So hope we answered all those questions for you. Hope that was very educational. Please like this video, if you appreciate that, and share it with your friends. Also, if you're like, hey, you know some people in this area.
Yeah, someone that's close to you that could find this valuable.
Yeah, and can benefit from just a chat with us. We'd love to do it.
Yes.
Phone number's on the screen, so you can call anytime. So 467.
1785.
There you go. I was like, get
I
in there.
was waiting for you to finish it.
No, and you can also just go to our website, teamtuttlerealty.com. You can
That's
message us
right.
on Facebook. So there's many ways to get a hold of us, as pretty much anywhere you go in this era of social media.
Oh, yeah.
And company communication.
Yeah.
We'd love to help you. Congratulations to our clients this week.
Yes,
Yeah.
absolutely. Another set of first-time home buyers
Yeah.
purchased a house and had
Scott and
good
Andrea,
closing.
they were looking for months to try to find that perfect home, and a lot of them, and I feel for them, because sometimes realtors will take pictures that look way better than what the home actually looks like on the inside, and that's disappointing. It's a waste of everybody's time when they do that, and it's a part of the business I don't like, and honestly think there should be policies against it, but there's not any. So sometimes these pictures are done up and it makes the home look way better. It looks like it's $1 million, and once you walk in, it's like filthy. There's stuff missing. You couldn't see it because it wasn't, the angle was different. There's all kinds of stuff that can happen. And so as a buyer looking for homes, you get really discouraged.
Oh, yeah.
And then when you do find a home that matches the pictures and does look good, guess what? You're not the only one that thought that, which means you're not the only one making that offer.
Correct.
Then you're in a multiple offer
Yeah,
situation.
that's right.
And as we talked about, your focus is on your monthly payment. And all of a sudden you realize, well, if I go an extra $5,000 or $10,000 more than what they're asking, I'm no longer in my monthly payment anymore.
That's right.
And I can't make that happen. And I don't want to stress myself past my means.
Right.
So on to the next one. So they ran into that a lot in that popular price bracket. So we finally got it. So it was good. It was the right spot of town for
That's
them,
right.
the right house square footage, the color tones, all that. So they finally got to go, and sort of thrilled for them.
Right.
So that process can take a while. They're not always easy. She has been a little rowdy today.
Yeah, they want to go outside.
I know. She's been to the door
I
3
know.
times whining.
I know.
I gotta go pee.
It's okay.
Yeah, we're better outside than inside.
That's right.
Tell you what, Yorkies are difficult to train. Oh, this one right here. Woo.
Oh, yeah.
Man, she thinks she's the boss.
Yes, that's right.
And she walks around saying, "You're not the boss of me." As she squats here and squats there. I'm like, oh, I most certainly am.
Yeah, but yet they have a doggy door.
Yeah, and they got a doggy door. So,
Yeah.
I don't know. She grew up alpha and still refuses to let that title go.
That's right.
That self-appointed title. But anyway, so, but yeah,
All right.
her and Larry are doing good, if you're ever wondering. We keep you updated on sometimes on how they're doing. And she's
almost a year.
Yeah, she's almost childbearing age. So you know what that means. Some baby Yorkies coming up.
Yeah.
So, by the way, if you are interested in getting a little teacup Yorkie, reach out to us. Let us know, because we'll probably have a
Can't get
few
down.
here in a few months. We'll see how things go
gosh.
between the two of them. Larry's already working on his charm.
That's
Yeah,
right.
He's been sweet talking her lately.
Yeah.
I think he smells the hormones. He's going, I think she's about ready.
Yeah, soon.
Yeah. Okay, listen, guys, appreciate you again watching this morning on this Saturday. Again, on the replay, also thank you for checking in. I know
Yes.
sometimes you have to watch this in stages, like any podcast that goes a little long, but it's filled with information that's valuable to you, like we always want it to be. It does take a time to consume.
Exactly.
Yeah, so we're cognizant of that. We do try to make them usually shorter, but today there was a lot, and you can't get through all that information any faster, I don't think, than what we did, if you want to have a complete picture of the market and the hows and whys and whats and all that. So there you go. All right, reach out to us anytime here at Team Tuttle Realty. Have a great day.
Thank you.
See ya.
Bye.